Good morning and welcome to this Wednesday, March 1st, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, currently looks like we've got futures pointing, well, they were up most of the morning. Now they're slightly lower. We got Dow futures down 58, S&P 500 futures down 7, NASDAQ futures down about 18. A lot of times what I do is I go over to stock charts, and I usually just go to the symbol summary, and I can pull up the QQQ or the spider, get a quick update on exactly what's going on. Right now, the QQQ is down 60 cents, so that's down about 0.2%. Spider is down about the same, down 0.22%. That's back down to 395.40. Diamonds also down almost 0.2%, down 0.17%. So it does look like we're going to get off to a little bit of a slow start this morning. We do have crude oil futures down, or crude oil prices down about $0.50 or so to 76.50 a barrel. And the 10-year Treasury yield up 4 basis points this morning, 3.95%. That rise likely spooking futures a little bit, would be my guess. But we'll see how the day progresses. It is March 1st, so we are starting off a new month. I can tell you that historically, this is the best time of March. The first 5-6 days of March tends to be the best 5 or 6 days. We do have another fairly strong period in the middle part of the month, leading up to about the, I don't know, maybe from about the 10th or 11th up through the 18th. And then the market tends to really struggle, go sideways more than anything as we prepare for the earnings season that will be starting in April. So that's kind of how the month typically unfolds. Looking at the charts, which we'll get into in just a minute, I would say probably, I don't see anything totally inspiring at this point. I think we're kind of in a range-bound mode for now. I don't know that we've quite found our short-term bottom. I would say the odds are we have, but I don't know. The afternoon selling last couple of days, I don't like to see that. I'd rather see the market strengthen into the close. We haven't really seen that. So I don't know. The market's just kind of teetering here, I would say. But again, we'll look at those charts in just a minute. For those of you who are new, welcome. Always appreciate having you join us. I do want to welcome all of our YouTube folks. We are streaming live now. We've been doing that now for the past couple of weeks. And it's always good to have new folks come in. I think we take a little different look at the market than most. I'm going to try to teach you about some of the things that I've learned over the years. And I've been studying the stock market for a long, long time, probably since back in the 1980s. And so there is a lot that you need to be aware of, maybe that you don't even consider currently. Things like history, the historical tendencies, that seasonality aspect of the market, I think is really important to at least keep in the back of your mind. It's not my primary focus, but it is always a secondary focus, always keeping track. But again, for those of you who are new, really appreciate you tuning in. If you want to kind of get to know us a little bit better, we do have a free newsletter. So I always like to start off the show welcoming the new folks, pointing out the newsletter that we have. If you go to earningsbeats.com, you scroll down, we have a free newsletter, our Earnings Beats Digest, published 3 times a week. Only takes name and an email address. That's it. Hit that subscribe button, you're in. There's no credit card required. You can unsubscribe at any time. I think it's a very educational newsletter. There are going to be some trading opportunities that you can take advantage of if you wish. That's completely up to you. But it'll give you a little bit of a sense of how we approach the market, how we approach trading. As far as market guidance goes, I think that folks who are buy and holders probably appreciate maybe the guidance better than anything else. But we do focus on guidance and education as well, in addition to all the research that we do. So again, you want to check us out, probably the best way to get started would be the free newsletter. If you want to check out our service, we'd love to have you. We do have a 30-day free, no-cost trial. So you click that button, you'll get going. You will have to give a credit card for that. So I'll let you know that in advance. But your credit card will not be hit until we send you another email out later in the month telling you that you're about to be charged. So we don't do anything, shady. We want to make sure that you understand what you're being charged for. We want to make sure that we're a fit before you're ever charged. So that's why we do the 30-day trial. Anyhow, be sure to check that out. All right, let's move on. What happened in the market on Tuesday to end February? Well, first of all, it was not a very good month for equities. Most of the aggressive areas did a little bit better in February than the more value-oriented or defensive areas. For instance, you can see clearly the Dow Jones had a rough February. We were up around the 34,000 level to start. We finished below 33, down 32,656. So we were probably down, I'm just kind of ballparking it, but probably somewhere in the 4 to 5% range in February. The S&P 500 was up closer to 4,100, I think actually around 4,080 to start the month. And we finished at 3970, so probably close to 3% down on the S&P. The NASDAQ, however, NASDAQ was rather flat. These were the first couple of days of February, so we started February somewhere around where we finished it. Maybe we were down 1% or so on the NASDAQ. So on a relative basis, the NASDAQ did outperform in February, which followed on the heels of outperformance in January. Huge month for the NASDAQ in January. Mid caps, you can see relatively flat since the end of since the end of January there. And then small cap, same thing. As far as yesterday's action goes, all of our major indices you can see were lower, but most of it was pretty minor. I did mention earlier, though, the afternoon selling. That's been a little bit of a problem the last couple of days. We've had some gains and it looked like, okay, maybe if we get a little strength in the afternoon, maybe we could break out of this period of consolidation, and it hasn't happened. So that's why I'm still just kind of maintaining a little cautiousness. I think once we get going and we start to trend back up again, I think this will be behind us, but I don't know if we're ready to do it yet. If we're going to do it, first part of March historically would be the time to do it. So I do think this rest of this week, maybe into the early part of next week, is the bull's opportunity to break us out of this short-term trading range. But we'll see whether or not that happens or not. If it does, I really like what's coming down the road. If we can't get through to the upside and we do break down, if we start seeing the NASDAQ or the QQQ, which is the ETF that tracks the NASDAQ 100, 289, 290 is kind of a key support level that I'm watching there. So if we lose that level, I would be much more cautious in the near term. I do think the S&P 500 potentially, and I just say potentially because I don't think it's going to happen, but I do think we could go back down to this low around 3,800, maybe 3,780. I think that was the low close. I don't believe we're going back down to the October low. Could I be wrong? Sure, I could be wrong. Many of you I know hold on to bearish thoughts and probably trading using bearish strategies. I am not. At this point, I believe the bottom is in. And when I believe the bottom is in, I no longer short. If I get nervous, if I get anxious, if I get cautious, I can go more to cash, or I certainly could stay away from leveraged ETFs, that sort of thing. I don't want to take chances when the market's trending lower. But overall, I believe we go higher in time. So I'm not one to sit back looking for shorting opportunities. The last thing I want to do, being bullish, the last thing I want to do is short and have the market go up. That's something psychologically that's difficult for me. So once I've called the bottom and I think we're going to trend higher, I'm either cautiously bullish or I'm bullish. There's no real, you're not going to hear me talking about being bearish long-term. Not unless my signals change dramatically. And most of them are still looking pretty bullish at this point. From a sector perspective yesterday, materials and financials led. Those were your two big groups. To the downside, it was kind of an odd group for the market to sell off late in the afternoon. Leadership, utilities, and staples among the losers. Those are your defensive groups. Just kind of odd. Markets pulling back. Usually when there's a sell off in the afternoon and all the major indices are lower, you'd expect maybe discretionary or technology to be down among the losers. And then we didn't have a great day in those areas, but they were not the primary laggards. As you can see, it was utilities down 1.75%, energy down 1.44%, and staples down about 0.8%. All right, so let's move on. 10-year Treasury yield. Let's get an update here. Right now, 3.95. When I started setting this up, it was 3.94. So we are seeing a little bit movement to the upside, getting close to the recent range. If we just pull up like an hourly 1 month, you can see that these highs up here have been, well, we'll get exact. So back on February 23rd, the high was 3.978. Then on February 24th, the high was 3.978. And then the high on the 28th was 3.983. So we're moving back up 3.95, but we're still got a little bit of room to those recent highs. But I would say that the trend, short-term trend, still remains higher. So we could go right through. And if we do, that's going to potentially open up the door to some of those numbers I gave to the downside. The S&P 500 back down to 3,800. The QQQ tracking the NASDAQ 100, that falling back below 289, 290. Those things I think are possible if the 10-year Treasury yield breaks out. If we sit here sideways, or if we start to roll back over again, I think that would set the market up for potentially a rally. Moving on, S&P 500. So looking at the market technically right now, I mean, we're just kind of hovering right here on the 50-day moving average. Not really seeing anything. You're talking about, coming off a bottom in October. What I look for is higher high, higher low, higher high. So we just don't want to go back down to a lower low. That's why I'm saying 3,780 to 3,800, because that's where we had the most recent lows. So if you're a believer that we're going higher, that the market has bottomed, that's a level that you want to hold. I mean, you've got this gap support that sits just below that I don't think we ever quite tested. That is at 37.48. The low here was 37.64. So we didn't quite get back to 37.48. I mean, that would be a stretch for me, but maybe, to really scare folks, if we did go lower, that 37.48 would actually go below, slightly below this prior low. Maybe something to look for if things really get nasty here over the next few weeks. But for now, I don't believe we go down that far. I believe we're going to continue to print higher highs and higher lows. And I really think we're going to move higher at the end of March into early April. I think as we approach the next earnings season, I believe, and that's historically when the market tends to move anyway. But that's when I see the next big move coming. The NASDAQ 100 doing better than the S&P. We did get that breakout above the prior tops. You can see that area from this top up to this top, right around 12,000 to 12,150. That seems to be the area of support. And if we look, closer at this, let's zero in just on, say, the last month. This is the trading range that I'm talking about right now, in the short-term trading range. So I think to break out of it, we need to see a definitive move up through 12,250. And to the downside, you've got this area of support over here, and then this 11.9. So I'm going to say 11.9 to 12,250 is kind of that short-term trading range. And if that breaks, well, let's see which way it breaks. If it breaks to the downside, then obviously that opens up some things to the downside for the market. If it breaks to the upside, then probably the short-term selling is over. Still could get into a period of more intermediate term consolidation. We set this high up at 12,850. This low would still remain the key low, looking at a monthly or an hourly chart on a 1 month basis. So kind of watch for that, but that's only if we break out above 12,250. For now, You can see we got a lot of gap ups, a lot of gap downs, mostly not great action. I mean, as you can see, we've only had one really bearish day that I would say, but almost every one of these days have been filled candles, meaning they're closing below the open. Now, much of it since the open here all the way down to here, most of the move to the downside has been gaps. And it looks like we're probably going to gap down a little bit, just updating you on the futures. Right now, NASDAQ futures showing down 35, which is down about 0.3%. All right. Moving on, I wanted to show you the Dow because I think the Dow, one thing to look for if the market does weaken, do we start to see rotation back to the Dow? And I say that because we're already back at support on the Dow. If you look back since November, I mean, there was that big gap up in the middle part of November, and then the prior low just prior to that was here. I would really like to see 32,000 to 32,005 hold, and we're at 32,006. So we don't have that cushion on the Dow to the downside that we have on the S&P and on the NASDAQ. Really, a loss of 32.5 would start to inflict some technical damage here. And at the open, we could be pretty close. So the Dow would be the first one to watch. But what I think, March tends to be a month, even we do go higher. The tendency is that we go higher. Since 1950, March ranks as the 5th best month of the year, fifth best calendar month. It trails November, December, April, and July. Those are the only 4 months that do better than the month of March since 1950. But March is a little bit different in that we do tend to see more defensive and value-oriented stocks do better on a relative basis in March. So it's kind of a weird month because normally when the market goes up, if you have a strong month, it's usually led by more aggressive areas. But March is a little bit different, kind of a stranger animal. It's the 3rd month in the quarter. And if you've followed the work that we do, the 3rd month of all calendar quarters tend to be the weakest and also tends to favor more defensive areas. So that's why I'm thinking the Dow being a little bit more value oriented, more conservative than both the S&P and the NASDAQ. Maybe we see this hold. Maybe this is the area that outperforms in the month of March. It'll be interesting to watch to see if that develops. Okay, let's talk a little bit about the relative ratios. I haven't really shown these a whole lot, mostly because the S&P 500 is just kind of going sideways, not really doing anything. What I normally use these sustainability ratios for, and I'll explain them in just a minute, is to either confirm or refute what the S&P 500 is doing. So if the S&P 500 is going higher and breaking out and setting new highs, I like to see my sustainability ratios moving up with it. If the S&P is breaking down to new lows, then I like to look at the sustainability ratios at that point to see if they're breaking down with the price action. Because if I see them all going hand in hand, if my ratios are going hand in hand with price action, then I tend to view it as a sustainable move in that direction. Well, the S&P 500 bottomed in October and started moving up. Most of my ratios kept going down in the 4th quarter. And if you follow history, a lot of times the 4th quarter, especially November and December, they tend to favor areas like the industrials, financials, not so much technology. I think semis may do pretty well, but most technology areas, consumer discretionary, communication services, internet stocks, they tend to not perform as well in the months of November and especially December. And so we saw some of that at the end of 2022. The NASDAQ's best month is January. And you can see the QQQ crushed the spider during the month of January. So history does tend to repeat itself, and it's worth paying attention to. But what I'm seeing right now is the S&P is kind of in this move up, back down, up, right now moving down, but we still got this short to intermediate trend, which is up. Now, for those of you who are on the bearish side, I will still confirm that we are in a downtrend. We're in a downtrend here until we get through 4,300. Because from a longer term perspective, if I go back over here to the S&P and we pull up the weekly chart, it's a little easier to see on a weekly chart, but here's a low, there's a lower high, lower low, lower high, lower low. And right now we're just in between this lower high and this lower low. So those of you who are saying, hey, this is just a pause and we're going back down, the weekly chart technically supports that. I don't disagree with that. We got a lower low, lower high, lower low, lower high, lower low, lower high. If we roll back over and break that back down below the lows in October, this downtrend remains in play. Nothing has changed. From a weekly perspective and looking at this long-term chart, it changes if we go through 4,300. To me, that is kind of the final straw. And for those saying, well, why are you calling a bull market if you haven't cleared that long-term weekly resistance? Well, I called a bear market back here when we were at a top. I said that the likelihood of a bear market had increased significantly when we were sitting at an all-time high. I don't wait to see, there was a, saying that I kind of made up, but when everything was starting to go down in March, February, March, April, May, I was saying back then, you don't need to see a tornado in your living room to understand that a storm is approaching. You can see the storm coming. You don't have to wait until your house is in a shambles. And that was the difference between getting bearish here and getting bearish somewhere down in here. So now the question I'll ask is, do you want to get bullish when you think the bottom is in, or do you want to wait and get bullish when you're at 4,400? I mean, if you wait until you break down to get out, and then you wait until you break out to get in, what have you done? Nothing. The reason I study the market is not to tell you that we're in a series of lower lows and lower highs. Anybody can do that. I could teach a first grader to see that this low is, that we're moving lower and lower. The real art to studying the stock market is understanding what's going on beneath the surface. This part's the easy part. When the signals start to change and you start to see accumulation and the sentiment completely reverses, that's when you need to start thinking about bottoms or tops. Not after it's already beaten you over the head. I remember when I was talking about the market going lower back at the beginning of 2022. And of course, all the bulls at that point, had issues with me. They're like, how can you call a bear market? A bear market's minus 20%. That's the definition, or that's the general understanding. Well, what good does it do to call it after it happens? Have you saved any money? I mean, you're down 20 or 25%, then you get out. Then what? I mean, isn't it better to see the problems before they surface? Isn't it better to see the light at the end of the tunnel while it appears the train's still coming at you? That's the difference. So yeah, I think we're trending higher. I think that bottom is in. And for those who are new, and I've said this several times, but I'll say it again, October has represented the low in 7 of the last 14 bear markets. If this truly is the bottom, 6 of the last 13. If this turns out to be the bottom, this will be the 7th time in the 14 bear markets since 1950 that the bear market ended during the month of October. October is a month when we tend to bottom. And my theory is that during September, all the dirty laundry is coming out. If you have a bad first quarter, management sweeps it under the carpet. Well, we got off to a rough start, but the rest of the year still looks good. We're still, kind of on course. Then you get into the second quarter, things still aren't so good. Management's like, well, first half of the year wasn't great, but we think the second half, we see a lot of improvement coming in the second half. You get to September and pretty much your year is toast. And so I think that it's a time when a lot of companies just say, you know what? We're not meeting our numbers for the year anyway. Let's just throw the kitchen sink in. And I think that is what triggers a lot of times bottoms. Just my own personal feeling after studying the market. I can tell you that the end of October to the middle of January is the best time of the year for stocks. And I tried to point that out again this past year, right in here. And once again, we went up. And I had folks saying, well, it doesn't happen every year. Not going to happen this year. Well, it happened again. So anyway, I think the market goes higher, but let's keep moving on. So getting back to this, these sustainability ratios off of the lows in October, and especially off of the December low, when we started moving up, look at the ratios. Here's the QQQ versus a spider. So this is NASDAQ versus the S&P 500 rallying. Think of the NASDAQ being more aggressive. S&P's got plenty of aggressive components. It's got many of the same stocks that the QQQ has, but the weighting is different. And so value represents more of the spider than it does the QQQ. Anyway, that's rising. And even though we've been pulling back, it's holding up pretty well. XLY, XLP, discretionary stocks versus staples. Discretionary stocks, these are companies that sell us the things we want. Staples companies, on the other hand, are the companies that sell us the things we need. Think about discretionary being Starbucks, being home builders. You don't have to want just a $5 thing. You can want a $500,000 thing. You can want a new house. That's a discretionary item. If you're staying somewhere, you don't have to move. You don't need to move, but you might want to move. That's discretionary. You don't have to do that. Need comes down to toothpaste. I hope you don't just brush your teeth when the market's strong. I hope even when the market's weak, you still get up and brush your teeth. Those are the things we need. We need soap. We need toothpaste. We need food. I mean, we may want some nicer food, but we need food. We need to eat. So discretionary is when the economy is stronger, you feel better about things, you spend discretionary dollars. You feel good about your job. Staples is when staples are leading the market, when staples are leading discretionary, that's not good. When the companies that are selling you the things you need are doing better than the companies that sell you the things you want, that's not good. Well, the XLY, XLP is strengthened. Big month in January, holding up okay so far here in February. We'll see. If we go back down, these are definitely ratios to watch. If they go back down below the lows we saw in December, we got problems, especially if the S&P has gone down to new lows. You know, I'll be like all the other bears out there. I'll be saying batten down the hatches if that happens. I don't think it's happening, but we'll see. I remain open. I remain objective to what's going on in the market. IWF, IWD, this is big large cap growth versus large cap value. Same thing with these two indices, the Dow Jones US large cap growth index versus the large cap value index. So you can see growth versus value going up in 2023. Same here. Mid caps, growth versus value going up. Small caps kind of a little bit flatter, still going up, but a little flatter. And then the last one I have down here is transports versus utilities. Normally when the market is strengthening, transports outperform utilities. So you got all that. Everything looks pretty good. So I'm okay from using my sustainability. I think they're fine right now. Got a lot of work to do to the downside to convince me otherwise. Moving on to earnings, just wanted to point out yesterday, this was kind of weird, but these were all the companies in this chart list that reported either Monday after the close or Tuesday before the open. We put all the stocks in a chart list so that we can just see. So here's the end of the day. These are all the companies that reported, and you can just quickly see the top 9 right here all gained more than 10%. And we can flip it over and see that the bottom 9 lost more than 10%. So it's kind of one of those days where it was kind of going both ways. But what I found interesting was healthcare providers. They were 3 in the top 6 that performed well. And I looked at the healthcare provider index, and it was actually closed at the lowest level that we've seen since June. That was really weird. And then when I looked at the underperformers, though, there was a healthcare provider here, 2 of, I don't know, maybe the bottom dozen. We had 2 of the healthcare providers in the downside. What I can tell you, I don't want to spend any more time on this, but both of these, ACHC and UHS, were both strong performers going into earnings. In other words, they looked like leaders, and yet they got hit hard. When we flip it over to the ones that saw good action, PGNY, I think this is the one that did not look very good. Yeah, this one had been downtrending relative to its peers, and it took off. But the other 2, actually HIMS and RadNet, both of these were strong performers that continued going higher. So these were the 2 actually that kind of made sense out of the 5 from healthcare. But anyway, just wanted to point that out. The other thing is a bunch of companies that reported after the bell yesterday. I'm just going to give you a few. I know it just turned 9:30, market just opened. So let me just give you a few of these that you might be interested in. So let's go over and look at the charts. Go through these really quickly. Monster Beverage gapping down below recent price support. That one scares me a little bit. We'll see whether or not I can rally back or not, but I have my doubts. Ross Stores gapping down right to this gap support level. This needs to hold. If it goes back down below today's low, I'd be very careful. Otherwise, this is one that could rally. Agilent Technologies, this is in the medical equipment space, breaking to another new low. I don't like that. If there's one saving grace, the AD line continues to move up, meaning that the stock tends to rally back. But this is after earnings. We'll see whether or not this is a different story. Rivian, remember on Monday, I said, be careful going into earnings with Rivian, down 9.5% this morning after reporting way lower revenues than expected. And their production guidance was weaker than expected. So that's how I use relative strength. Look at Rivian relative to the autos. It had literally just been falling off a cliff for the last 3 or 4 months. And now we find out why. And the market did not like the report. First Solar gapping up, trying to make a big breakout. Let me see here. The big resistance on this chart, that's 181. 181, today's open was 180.55. So it did not open above. What I would be careful about, if it gets through 185.28, that would be an intraday breakout. But because it didn't gap up above resistance at the open, I would be leery. And what I mean by that is if later today, this stock is trading back down below 81, I think it could be putting in a short-term top. So you want to be careful. When we get a gap up like this, I like to see the open above any of the prior candle bodies. Not the intraday highs, not the wicks, the shadows, none of that. I want to see it above the candle bodies. We didn't quite get that with First Solar. So yes, we're breaking out, but yes, I'm skeptical. We'll see if it holds. AMC. A lot of folks like to trade this one. Earnings were not great. And you can see gapping down, stock down 6% today. MQ, this is a semiconductor that's getting clobbered. Look at the relative strength. This one's been going down, or I think I said semiconductor software, I'm sorry. This one's been going down relative to software for 9 months. And it was at a 52-week low right before earnings. Wall Street is screaming at us. This is not good. So should we be shocked when the stock's down 25%? No, there's no way I would hold a stock that looks like that into its earnings report. KSS, Kohl's, another one that had rough news, gap down. It is trying to come back pretty close to break even at this point. Last one I'll give you here is DUOL. I believe this is another software. It gapped up just shy of key overhead resistance near 105. I don't know if it's going to get through today. I mean, obviously a nice gap up, stock up 14%. But it had this huge move, pulled back, and did respond pretty positively. And by the way, the EB Digest I did today, I think the stock that I featured, they report earnings tonight, I think looks somewhat similar to this one. Nice rally, showing some recent relative strength, pulls back right before earnings. I think it could get a gap up similar to what DUOL did. So that's, again, just kind of a sample of what we do with our Earnings Beats Digest, talking about some of these things. So make sure you do subscribe for that. All right, that is it. Let's take a look, see what's happening in the market real quick. We do have the NASDAQ down 25, S&P down 9, Dow down 31. We are seeing a little bit of relative strength in the Dow as we open up March. As I mentioned, that's kind of one of the tendencies. So maybe if you are bullish and you're in the QQQ and you're not sure, maybe should I be a little bit less risky? Maybe it makes sense to go into the diamonds, or maybe partially into the diamonds or the spider. The NASDAQ doesn't usually perform as well in the month of March. But that's completely up to each individual. I'm sticking with the NASDAQ personally. So I'm sticking with the QQQ. And we are down around a key support level, that 289, 290 level I talked about. So for me, and what I've been telling members is, as the market pulled back, I was actually slowly moving from the QQQ into some of the leveraged ETFs. If we lose 289, 290, all bets are off. I would not be in any leverage. That's all I'll say. Anyhow, that's it for me. Have a great day, everybody. Relax. I do want to mention I'm going on vacation from this Friday through the following Friday. I'm going to be out of the country. I'm not going to be doing my shows for a week. So I do want to wish everybody a good, solid week. We do have a jobs report that's coming out on Friday, but otherwise, I think it'll probably be a fairly quiet week. Not a lot of earnings, not a lot of things going on. No Fed meetings. So I'm thinking when I get back, it'll probably be similar to where we are now, but who knows? Anyway, have a great day, everybody. Happy trading.